And also have everything documented really well.
Yes.
So if you are going to deploy these tax strategies, you need to have everything documented, the dates that they were done, the reasons why. You need to have the receipts so that in case of an IRS audit, you have all of the backing to support these strategies that you took advantage of. Have you ever wondered how much you should pay yourself as a business owner and how to do it the right way? Well, today we're going to be talking about how to pay yourself consistently as a business owner. So, Emily, what do you think is the first thing that people ask you about when it comes to paying themselves?
Oh, they ask everything. They're like, how much do I pay myself? When do I pay myself? How do I pay myself? And I feel like always I'm like, it depends. And it does. It does depend on what your situation is and what your entity type is. So, Andrea, for those that are out there that are sole proprietors, that are LLCs, that have not elected any other election of how to be taxed, how should they be paying themselves?
So, as a sole prop, this is probably the easiest way to pay yourself because all you're going to do is you're going to make transfers from your business account to your personal account. So these are called distributions. And basically, you are transferring cash from the business to your personal. You're not spending money from your business account for personal items.
Right.
You're going to make clear, easy transfers, usually on the same times each month, like the 1st and the 15th, for the same amounts, like rounded numbers, $5,000, $10,000, whatever that would be. It wouldn't be for random amounts here and there. So that's how sole proprietors pay themselves.
Yeah, and I think those people that are just starting out, that's typically the most common question, like, how do I do it and do it in a way that is beneficial to me? And I think the biggest thing to keep in mind is the way you're taxed as a sole prop is when we start having questions around maybe changing your tax election, depending on how much you're netting at the end of the year. And so that is usually why we recommend people to make those changes, is that net income hits that 70 to 100K mark. And we're like, hey, this is actually probably beneficial for you. And I will say that is 100% state dependent. And it, sometimes even that 70K is kind of low. We really are focused on cash flow for our business owners. And we've found when people are at that 70 to 80K net income, so not that top line revenue, but like that bottom line after all expenses, it can still be tight for a season because they're starting to prepay their taxes with their W-2, payroll, and all of that jazz. So I think that's a great segue into how should business owners pay themselves as S-Corps?
So as an S-Corp, you need to be on payroll and you need to be paying yourself an annual salary. And you'll be paying in Medicare and Social Security each time that you pay yourself through payroll. Now, it's important to do a reasonable comp study or analysis to see how much you need to pay yourself as an S-Corp owner, but it often depends on the job that you're doing, your role, the location that you're in, the market rate for a similar position that you're doing. And you can pay yourself through payroll, and then you can also give yourself distributions, which is, again, that transfer from the business account to the personal account.
Yeah. The other thing with reasonable comp, the other factor too, is how many hours you're working, right? Because if you're only working 20 hours versus 40 hours, that also will dictate how much your reasonable comp should be too. I know this as I have looked at mine a few times, and I'm like, I really don't work 40 hours. So paying myself at 40 hours doesn't actually make sense because that wouldn't be reasonable for the person that's going to come in and do this, right? The other thing with reasonable comp is one thing we evaluate consistently is making sure your reasonable comp salary is greater than your distributions. Isn't that one of the things that we kind of, level set and check on a regular basis? Because that can get you in a little bit of a question.
Yeah, we definitely compare what your distributions are to your salary because the IRS does not like when you have a ton in distributions and you're paying yourself a low salary. So if that's happening, you could come under a reasonable comp audit because the IRS likes to go back and say, hey, you owe all of these payroll taxes, you owe all of this Medicare and Social Security tax because you weren't paying yourself. So a good general rule of thumb is to do 60% through payroll and 40% as distributions. That will keep you safe. That will keep you out of the IRS's sight. So that's a good way to do it.
I think that's a really good point because the other thing you can do is if you need to make a tax payment and you do so, you would do that through your distributions. So you could very easily knock yourself out of that 40% via that distribution as well. So what do you do in those cases?
Yeah, so a lot of times as an S Corp owner, you're going to owe a lot of tax because of the S Corp income. And you need to take a distribution out of the business in order to cover your tax bill. When that happens, that's perfectly fine to take that tax distribution. But one thing to note is that is a distribution. It's not a business expense. So a lot of times people will code that distribution as tax expense, state tax expense, federal tax expense, thinking it's going to reduce their net income and ultimately reduce their tax bill. But it's actually a distribution of equity from the company.
Yeah. I think that a lot of people don't know that that's how it works. And I think it's important that you do know because if you are factoring in that you've made these tax payments and that's reducing your net income, you're going to be in a situation at the end of the year because your net income is going to be much higher than you anticipated because you factored out the expense, but your tax preparer is like, hey, that's not actually a qualified expense, right?
Right. I mean, as an S Corp owner, all tax is paid at the individual level. So technically it's considered a personal expense.
That's a good way of framing it, just so to be able to remember that. Also, when you make that tax election as an S Corp, you get the opportunity to be able to find additional tax advantageous ways to bring more income into the home that is not through the W-2, not necessarily through distributions. What are those?
There's a few different ways that you can do that. The most common way would be to set up an accountable plan. So you're basically reimbursing yourself for purchases that you've made through your personal accounts, like that are business expenses. And then another way would be to pay your kids through payroll, and you can shift some of that income from your higher tax rate into your kids' low zero tax rate.
Yeah, I think those are great examples. I think another one would probably be like the Augusta rule too. If you're able to rent your home back to yourself to hold meetings instead of going and outlaying that expense somewhere else. But these are all things that you need to know how to do it right and well so that you don't find yourself in a circumstance later. Wouldn't that be fair to say?
Yeah, definitely. And also have everything documented really well.
Yes.
So if you are going to deploy these tax strategies, you need to have everything documented, the dates that they were done, the reasons why. You need to have the receipts so that in case of an IRS audit, you have all of the backing to support these strategies that you took advantage of.
Yeah, I love that. And that is something we do as part of our tax strategy packages. Like, we're not the ones that will say, hey, here's the strategies you can use. Go figure it out and do it. We actually walk alongside you, ensure that you kind of have all your boxes checked along the way. And I always recommend when somebody makes that tax election for an S Corp, that very first year, I always encourage tax strategy, because when you make that election, you are now opting in to have all these other strategies that are available to you. And most of the time, if you don't have a rather complex situation, you can opt into strategy 1 year and then run that strategy every year until your situation changes too.
Right, because you'll have the skeleton and the outline to do it every single year, and you'll have, how to do the documentation right. You'll have all of the logs for like your auto mileage, your home office, like you'll have everything there that you can just keep running every year.
Yeah. And when you know that you can be paying yourself the same or more and paying less taxes on it, why wouldn't you want to do that?
Right.
It's kind
You're
of
already
a no-brainer.
doing these things anyways. You might as well pay less tax.
Exactly. So that is what we wanted to share with you today. Keep it short, simple, and sweet. How to consistently pay yourself as a business owner. If you have any questions, we're always available for any Q&A, anything of that nature. If you have any thoughts, find us on Instagram at Thorn Advisors.